we've now gone through the different costing methods, and we're going to just take a quick look at a couple other concepts related to inventory. So the first three that you see here, I'm not going to discuss these in our videos. You can just read the pages in the textbook. So starting at page 334, and it goes through how these apply to inventory. But we're going to go through here and look at accounting conservatism, what that is in general, and how it relates to inventory. So conservatism is a general term that is applied to all areas of accounting. So not just inventory, but we'll see it in accounts receivable in a future chapter. So conservatism applies to all accounting principles. And this principle says that if there is any doubt or uncertainty, items should be reported at the amounts that lead to the most cautious immediate results. So this is talking about in situations where there's kind of uncertainty and there's these two or more potential scenarios that could happen. So we know in life there's times when we don't know what's going to happen in the future, and there's this doubt or uncertainty. So if you come across this and you've got two potential scenarios, you would need to look over these scenarios, consider the facts, what's going on, and try and figure out what you think is most likely to happen. So be realistic based on the facts in those circumstances and figure out what's most likely. And if you can come up with a pretty reasonable estimate, you would go and do the accounting based on that. But sometimes you get a scenario where you just have no idea what's going to happen, or you can't have a reasonable guess of what will happen. So in that case, if there is enough doubt and uncertainty about what's going to happen, you need to choose the most conservative way to report that transaction or report that information in your accounting records. So I often kind of think of this as you make yourself look the worst on your statements based on the two scenarios, two or more. So it's not like you go crazy and over-exaggerate and just make these statements look awful. But based on the uncertainty within these couple of scenarios, you're going to choose the most cautious or the most conservative, and that's in effect going to make you look the worst, and you're going to report it that way. In the future, if the better scenario ends up happening, great, then you adjust for it then. But when we're at this point of doubt and uncertainty, we need to look the most conservative. So that's in general, and where this comes into play with inventory is looking at the lower of the cost and net realizable value rule. And this rule tells us that inventory needs to be reported at the lower of either the historical cost or the net realizable value. Now the historical cost, that's what you paid for it. So that's what it's actually sitting on the accounting records as. You record where you have a purchase of inventory, you debit inventory for that historical cost. So this is typically what's sitting on the books. The net realizable value, this is what you're going to realize or get when you actually are able to sell the inventory. So this net realizable value is equal to the selling price, how much can you actually sell it for, minus or less the cost to sell. So a cost to sell could be like if you had to pay commission along with that, or if you had to run advertising. So those are costs to get those items sold. So in the end, it's the amount or the net realizable value, what you're going to actually receive as your net cash after you've sold these goods. So we need to look in circumstances and see if this net realizable value actually falls below our historical cost. So if we think that the amount we're going to sell it for is less than what we actually paid and what's recorded on the books, we need to write down our inventory. So we're going to do an adjustment and put it down to the lower amount, which would in this case be the net realizable value. So if this happens, we call that impairment of inventory, because the cost has been impaired and it needs to be written down to this value that we're actually going to sell it for. And this is us being conservative because we don't know for sure what the selling price that we'll get is, but if we think, and there's this uncertainty, we think we're going to get this lower amount, we need to show our accounting records at that lower, more conservative, or worse off value for our inventory. So when would this happen? Does anyone have any ideas when you might get to a situation in real life where the net realizable value, what a company is able to sell something for, is less than what they actually paid or what it cost them to get? Any thoughts? One that you would often see throughout the year is seasonal items. So if we're thinking about Christmas or Halloween, things like that. Once you get through that season, things always go on sale because companies or businesses just want to get rid of that inventory. So they may end up selling. This net realizable value might be less than what they paid for it, but they want to get rid of it, so they'll drop the price just so they make a sale. So we're right around Halloween time. November 1st rolls around, Halloween candy always goes on sale. It's a perishable good, so those chocolate bars won't last forever. Places like Walmart, they put their Halloween candy on sale after Halloween just to get rid of it. So they might end up selling it for less than they actually paid. So they would have this impairment. So let's look at an example of how this works. Plenty paid $6,000 for Christmas blend tea inventory on September 26th. By December 31st, so after Christmas, the seasonal inventory can only be sold for $4,000, and the decline in value appears permanent. In order to sell the goods quickly, an online advertisement costing $500 will be required. So is an adjustment needed? And if so, what is this? So we need to look here at what is the lower of the cost or the net realizable value. And we're going to compare those. We need to have our inventory at that lower amount. So the cost, our historical cost here, is the $6,000 that they paid for this when they bought it in September. So that's what's sitting in the inventory account right now, $6,000. Our net realizable value is equal to the selling price minus the cost to sell. So you can see in the question here, our selling price, it can be sold for $4,000, and the cost to sell is this advertising. So just to get rid of it, they have to pay $500. Oops. That should be $4,000 minus this $500 cost to sell for the advertising. So our net realizable value is $3,500. So what is lower? Well, it's pretty clear here that our lower amount is our net realizable value. So in fact, we have impairment of this tea inventory, and we need to write this down so that we're showing it on our records at the lower amount, which is the $3,500. So on December 31st, when we figure this out and we reviewed this, we can do our journal entry. So our inventory account is sitting at $6,000, but we want to adjust it down to $35,000. Therefore, we need to credit our inventory. And we need to say $6,000 is what it's at, minus the $3,500. That's our goal, or that's what we want to get to. So we credit it for $2,500. Now the debit for an impairment or a write-down of inventory is just into cost of goods sold. So we'll debit that for the $2,500. And we would say to write down T inventory. Now, we didn't technically sell this inventory, but impairment is a risk or a cost that just happens as part of selling goods. And therefore, it is a cost of selling, and so we put this into cost of goods sold. So the items weren't sold, but it's a cost of this, and that's where we record it. In the real world, some companies may decide that impairment of inventory is important enough to track separately and may actually have an account that's called loss on write-down of impairment, or write-down of inventory, or impairment of inventory loss, or something like that. So they have a fully separate account where they would only record any amounts where inventory is impaired. So if a company had that, they would debit loss on write-down of inventory instead of cost of goods sold. But for our purposes in this class, we'll just put it as a debit to cost of goods sold.